Accenture just beat earnings expectations, so why is the stock sinking? One of the world's top consulting giants is undergoing a quiet storm, shrinking contracts, federal pullbacks, and big AI bets. Is this a rare buying opportunity or a red flag? Stay tuned to find out what's really going on with Accenture. Founded in 1951, Accenture delivers a wide range of professional services that include strategy, consulting, and technology solutions. The firm helps most of the world's largest companies improve their operations and IT infrastructure by providing systems integration and application management, data management, security, software engineering, AI, and automation services. Accenture works across dozens of industries, including consumer goods, retail, life sciences, banking, insurance, communications, healthcare, chemicals, and utilities. The company currently offers a starting dividend yield of 2.23%. while the 5-year average is only 1.46%. The price-to-earnings ratio is currently 19.1, compared to a 5-year average of 27.3, while the sector average is currently 23.8. The expected price is currently estimated to be between $328 and $401, whereas the company can now be purchased for around $255, making it appear significantly undervalued. Accenture currently pays an annual dividend of $5.92, distributed quarterly. The next payout will be on August 15th, and anyone who owned the stock by July 10th will be eligible. The following payout is likely to be an increased amount, which means the yield on cost could rise shortly after the purchase. The most recent dividend increase was on September 24th last year, when the dividend was raised by 14.7%. The 5-year average increase is 12.9%, while the 10-year average is 10.6%. It is clear that dividend growth has been accelerating over the past 10 years, though this does not guarantee the trend will continue in the future. The earnings payout ratio over the past 12 months was 47%. For similar companies, a payout below 60% is expected, and Accenture has consistently maintained this level over the past 10 years. The same applies to the free cash flow payout ratio. Both earnings per share and free cash flow per share have been steadily growing year over year. The earnings per share growth and sales growth charts have remained positive over the past 10 years, although growth has noticeably slowed in recent years. We'll discuss the reasons behind this in the second half of the video, so stay tuned if you're interested in the cause. The company consistently repurchases its own shares, and total sales have been increasing steadily. These are key factors for long-term investors. While the return on equity and return on invested capital charts have shown a declining trend for some time, both metrics still remain well above minimum expectations. Operating and free cash flow margins have also consistently stayed above the minimum expected levels over the past 10 years. The company currently holds more cash than debt, which is why there's effectively nothing visible on the net debt to EBITDA and net debt to capital charts. Naturally, the interest coverage is also in excellent shape. The company is currently available with a record high starting dividend yield of 2.32%, even though the next dividend increase is still upcoming. This is likely to be a significant raise again, considering the last increase was 14.7%. The credit rating is AA-, which is considered very strong, and the dividend appears to be very safe. Based on these factors, the company seems significantly undervalued. You might be asking, if this company is so great, why hasn't anyone noticed? In the second half of the video, we'll also talk about the challenges the company will have to face in the near future. So definitely stick around if you want to understand the full picture. Disclaimer: this video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video. Alright, let's break down Accenture's latest earnings report for Q3 fiscal 2025. On paper, the results are strong, but the stock still took a hit. So what's going on under the surface? Let's take a look. Let's begin with revenue, because that's usually the first headline number investors look for. Accenture brought in $17,730 million in revenue this quarter. That's up 8% compared to the same quarter last year in US dollars and 7% in local currency. Notably, this beat their guidance range, especially after adjusting for foreign exchange. This tells us that, despite global uncertainty, client demand for Accenture's services remains strong across the board. Now let's break that revenue down by the types of work Accenture delivers. Consulting revenue came in at $9,100 million, up 7%, and managed services hit $8,720 million, up 9%. This balance between project-based work and ongoing support is healthy. It shows companies are investing in transformation, but still looking for long-term operational help too. Let's take a quick look at how this breaks down geographically. In the Americas, revenue rose 8% in dollars and 9% in local currency, leading all regions. EMEA followed with 8% growth, and Asia-Pacific grew more modestly at 5%. This shows that North America continues to be a stronghold, while Asia-Pacific likely reflects some conservative enterprise budgeting and macro pressure. Okay, so where is this revenue coming from, in terms of industries? The biggest standout this quarter was financial services, which posted 13% growth. That's a clear sign that banks, insurance companies, and fintechs are investing in compliance, digital infrastructure, and AI-driven transformation. Other industries like health and public service, products, and resources posted solid, steady growth between 5% and 7%, a strong base for Accenture. But now, let's talk about something that raised some eyebrows. New bookings. This quarter, new bookings totaled $19,700 million. That's actually a 6% decline compared to Q3 last year and 7% lower in local currency. Why is that a big deal? Because bookings are a forward-looking metric. They tell us how much future work is in the pipeline. And this is the second quarter in a row where bookings have dropped. That's likely a key reason investors have been a bit cautious. Looking deeper, consulting bookings were $9,080 million, and managed services made up the rest at $10,620 million. Now let's talk about something that's not declining, AI. Accenture booked $1,500 million in generative AI work this quarter alone. That's a huge deal. It signals that clients aren't just talking about AI, they're actually putting serious money behind it. This is a long-term growth driver for Accenture and a key reason some analysts remain bullish despite near-term booking softness. Let's shift gears now and talk about profitability. Accenture's operating margin came in at 16.8%, up from 16.0% last year. That's an 80 basis point improvement. Their net income rose to $2,240 million, and diluted earnings per share EPS increased 15% to $3.49. Even when adjusted for prior year optimization costs, EPS was up 12%. So while revenue grew 8%, profits grew even faster, meaning Accenture is becoming more efficient while expanding. Now let's take a look at cash flow, dividends, and share buybacks. Three big signals of financial health. Free cash flow this quarter was $3,500 million, up from $3,020 million a year ago. That's a great number. It gives Accenture the flexibility to return value to shareholders and reinvest in growth. And they did just that. Accenture raised its quarterly dividend by 15%, now paying $1.48 per share. They also repurchased 6 million shares this quarter, spending $1,800 million, including nearly all of that in open market buys. These moves suggest the company sees its own stock as undervalued and wants to reward long-term investors. All right, let's talk a little bit about the company's outlook moving forward. For the full fiscal year 2025, Accenture now expects revenue growth of 6 to 7% in local currency, an operating margin of 15.6%, and EPS between $12.77 and $12.89. They also raised their free cash flow guidance to $9 billion to $9,700 million, showing confidence in both profitability and cash generation for the remainder of the year. Overall, this is a cautiously optimistic forecast. It acknowledges some near-term booking pressure, but still reflects long-term strength. So to wrap things up, let's summarize the key takeaways from this quarter. Recap. What's actually going on here? So stepping back from the numbers, what's actually working for Accenture right now? Well, both revenue and profit came in above expectations, which tells us the business fundamentals are solid. Earnings per share jumped 15%, and margins improved, meaning they're not just growing, they're growing more efficiently. They're generating strong cash flow, which allowed them to boost their dividend by 15% and continue buying back stock aggressively. Clear signs of confidence from leadership. And let's not forget the $1.5 billion in generative AI bookings. That's not a side story anymore. It's becoming a real growth engine. Even better, despite market concerns, Accenture kept its full-year guidance intact and even nudged parts of it slightly upward. But what should investors be watching closely? Well, the biggest concern is that new bookings fell for the second quarter in a row. That's the pipeline, the work that turns into future revenue. A slowdown there can't be ignored. Growth in Asia-Pacific is also losing momentum, and some investors are starting to wonder whether short-term demand, especially for consulting, is starting to soften. It's not panic time, but it is a signal to watch closely in the quarters ahead. So the big question is, are investors overreacting to a short-term bookings drop, or are we seeing the early signs of broader demand weakness? With strong financials and long-term AI positioning, Accenture could be quietly building momentum if it can navigate short-term uncertainty. But now I want to hear from you. What's your take on Accenture? Had you heard of the company before this video? Are you already tracking it? Or maybe even holding shares in your portfolio? Do you think it's a long-term winner, or are you staying on the sidelines? Drop a comment down below and let's talk about it. I read every one of them. Mastercard just dropped a massive Q2 earnings beat. Revenue is soaring, cross-border spending is exploding, and margins are holding near 60%. But is the stock still a buy, or are there warning signs hiding beneath the surface? Let's break it down. Founded in 1966, Mastercard operates one of the world's largest payment networks, enabling credit, debit, and prepaid transactions for consumers, businesses, and governments. The company generates revenue primarily from fees on transactions processed through its payment network and from licensing its brand to financial institutions that issue Mastercard-branded cards. Mastercard also offers value-added services, including fraud prevention tools, data analytics, and cybersecurity solutions. The company currently offers a starting dividend yield of 0.54%, slightly below its 5-year average of 0.56%. The price-to-earnings ratio stands at 32, compared to a 5-year average of 33, while the current sector average is significantly lower, around 11.3. Based on current estimates, the expected fair value range for the stock is between $518 and $633. With the stock currently trading around $560, Mastercard appears to be fairly valued at today's price. Mastercard pays an annual dividend of $3.04, distributed quarterly. The next dividend payment will be on August 8th, and shareholders who own the company's shares by July 9th at the latest will be eligible for it. The most recent dividend increase was 15.2%. The average increase over the past 5 years is 14.5%, and the average dividend growth over the past 10 years has been 18.8%. Additionally, the company has paid and raised its dividend every year for the past 13 years. The earnings payout ratio and free cash flow payout ratio are both at very low levels and have even been on a declining trend for a few years despite the high dividend increases. Earnings and free cash flow per share have been steadily growing year over year, with a slight dip in 2020 due to COVID, which is not surprising. Earnings per share has been growing comfortably above 10% annually, and the same can be said for sales. The company continuously buys back its own shares, which is something long-term investors appreciate, and the total sales chart also shows strong year-over-year growth. Return on equity and return on invested capital have been at impressive highs over the past 10 years. The same applies to operating and free cash flow margins. Net debt to EBITDA is at very low levels, while net debt to capital has been above the preferred 0.4 threshold over the past 5 years. However, interest coverage remains at very healthy levels. Mastercard is currently available with a starting dividend yield of 0.54%, and the most recent dividend increase was 15.2%. The credit rating is A+, and the dividend appears to be very secure. I believe the company can continue to raise dividends by over 10% in the future. Since it is currently purchasable at a fair price, in 10 to 20 years, it could generate a substantial return thanks to its high growth potential. At that point, it may also be worthwhile to hold the shares for the dividend alone, due to the huge yield on cost. Now, let's go over the positive and negative aspects of Mastercard's latest earnings report. Net revenue, $8.13 billion, up 16% year-over-year on a currency-neutral basis. Adjusted operating income, $4.87 billion, up 17%. Adjusted EPS, $4.15, a 14% increase. Operating margin, 59.9%, up 0.5 percentage points. Share repurchases, $2.3 billion in the second quarter, plus $1.0 billion through July 28th. Why it matters. Growth was driven by a strong payment network, value-added services, and foreign exchange volatility. EPS got a boost from share buybacks, but was slightly offset by a higher effective tax rate, 20.9%, due to global minimum tax rules. Gross dollar volume GDV and payment activity. Worldwide GDV up 9% year-over-year. US up 6%, debit up 7%. International up 10%, credit up 9%, debit up 11%. Cross-border volume up 15%, driven by travel and non-travel cross-border spending. Significance: cross-border transactions are high margin for Mastercard. The continued strength here, especially in travel, indicates solid consumer activity and global economic resilience. Transactions and cards. Switched transactions, up 10% year-over-year. Total Mastercard and Maestro branded cards, 3.6 billion globally, up 6%. Contactless share of in-person purchases, 75%. Why it matters. This shows strong adoption of digital payment infrastructure and behavioral shifts toward tap-to-pay, especially post-pandemic. Mastercard benefits from this trend in both volume and efficiency. Revenue segments breakdown. Payment network. Revenue up 13%. Value-added services and solutions up 22%, approximately 4 percentage points from acquisitions. Growth drivers: cybersecurity, digital authentication, customer engagement solutions. Analysis: Mastercard is evolving beyond just a payments network into a high-margin tech-driven services provider. This diversifies revenue and supports margin expansion over time. Key metrics: payment network. Domestic assessments up 9%. Cross-border assessments up 15%. Transaction processing fees up 18%. Other network assessments, $260 million. What this shows: revenue is growing faster than volume in some categories, thanks to pricing, foreign exchange volatility, and favorable transaction mix. Strong performance across nearly all network-based metrics. Operating expenses. Total adjusted operating expenses up 14% currency neutral, G&A up 13%, marketing up 23%. D&A up 14%. Acquisitions contributed approximately 4 percentage points to expense growth. Interpretation: spending is strategic, aimed at infrastructure hardening, global expansion, product enhancements, and cybersecurity. These are investments in long-term competitiveness, not short-term inefficiency. Regional and market trends. Some slowdown in cross-border travel growth in Middle East and Africa due to geopolitical tensions and tougher comps. Cross-border CNP, non-travel, remains strong, with approximately 20% year-over-year growth. July trends. Volumes and transactions remain stable post-second quarter. why it matters. Despite minor softness in select regions, broad-based consumer demand remains intact. Mastercard's geographic and segment diversification cushions regional fluctuations. Positives and negatives. Overall, Mastercard delivered a very solid quarter with several strong positives worth highlighting. Revenue and earnings per share both showed robust year-over-year growth, underpinned by strong performance across their core payment network. One of the biggest tailwinds continues to be the strength in cross-border and online, card-not-present volumes, areas that typically offer higher profitability for the company. In addition, the company's value-added services segment continues to expand rapidly, contributing to margin stability and long-term growth diversification. The continued share repurchase activity, $3.3 billion total through July, also supports shareholder value and helped lift EPS. Operating margins remained near 60%, which is exceptional for a company of this scale and reflects disciplined cost control alongside revenue momentum. On the flip side, there are a few areas of concern to keep an eye on. The company's effective tax rate rose significantly to 20.9% due to the implementation of global minimum tax regulations, which had a slight drag on net income growth. Operating expenses also increased meaningfully, driven partly by recent acquisitions and higher investments in technology infrastructure. While these are strategic, they do weigh on short-term margins. Regionally, there was some softness in cross-border travel volumes in the Middle East and Africa, primarily due to geopolitical factors and tough year-over-year comparisons. Lastly, ongoing foreign exchange volatility continues to impact visibility and predictability in certain revenue streams, especially in transaction processing and international segments. Despite these challenges, Mastercard's fundamentals remain strong, and its strategic positioning continues to support long-term value creation. But now I want to hear from you. Do you currently hold Mastercard shares in your portfolio? And based on these latest results, do you think MA stock is a buy at today's price, or is it already priced for perfection? Let me know your thoughts down in the comments. I read every one. Water is the new oil, and Xylem might be the company leading the charge. But after their latest earnings report, the question is clear. Is now the time to invest, or is the stock getting ahead of itself? In this video, we'll break down Xylem's Q2 2025 results, look at the risks, and see if XYL deserves a place in your portfolio. Launched in 2011 after being spun off by ITT, Xylem sells water-related engineered products and solutions. The firm designs water pumps, controls, and treatment equipment under various brands like Flicht and Godwin, supporting water infrastructure and applied water systems. It also provides smart meters, leak detection, and asset management services. Additionally, Xylem offers maintenance and environmental solutions, including filtration and reverse osmosis services. The firm's products are used in public utility, residential, commercial, agricultural, and industrial settings worldwide. The company currently offers a starting dividend yield of 1.11%, compared to its 5-year average of 1.17%. The price-to-earnings ratio is currently 30.4, slightly below its 5-year average of 32.3, but still above the industrial sector average of 22. The expected price range is between $123 and $150, and with the stock currently trading around $145, it appears to be fairly valued at this time. Xylem currently pays an annual dividend of $1.60, distributed on a quarterly basis. The next payment is scheduled for September 26th, and investors must own the stock by August 29th to be eligible for the dividend. The most recent dividend increase was 11.1%, compared to a 5-year average of 8.4% and a 10-year average of 10.9%. Despite being a relatively young company, Xylem has consistently paid and increased its dividend every year for the past 13 years. The earnings payout ratio is at a very healthy level of 32%, and over the past few years, we've seen a strong downward trend, despite the company continuing to raise its dividend at a rapid pace. A similar trend is visible in the free cash flow chart as well. Earnings per share has been growing steadily year over year. There was a slight dip during the past decade, most likely due to the impact of COVID-19, in 2020, though feel free to correct me in the comments if there was another reason. Free cash flow per share has also shown strong growth over the past 10 years. Looking ahead, EPS is expected to grow by 9% over the next 12 months. While the sales growth chart shows some volatility, the company has demonstrated strong growth overall. On the shares outstanding chart, there was a noticeable spike after 2022. That's because in May 2023, Xylem announced it would acquire Evoqua, a leading player in the water treatment industry, through an all-stock transaction. The deal was valued at approximately $7.5 billion, paid entirely in Xylem shares, which led to an increase in shares outstanding and shareholder dilution. So why was this deal worth it? Evoqua strategically complements Xylem's portfolio in the industrial and wastewater sectors. Management estimates over $140 million in annual synergies. The acquisition strengthens Xylem's position in the fast-growing water technology market tied to environmental sustainability. Importantly, the total sales chart reflects this acquisition-driven growth. That's crucial for long-term investors. If a company issues new shares, total sales must grow at a similar or faster rate to justify it. However, return on equity and return on invested capital have mostly been below desired levels in recent years. In contrast, both operating margin and free cash flow margin have shown a strong upward trend. Debt levels have been declining consistently since 2016, something all long-term investors appreciate, and the company's interest coverage ratio has been steadily increasing, another positive indicator of financial health. The company is currently available with a starting dividend yield of 1.11%. The most recent increase was 11.1%, and such rapid dividend growth is characteristic of the company. It holds a credit rating of BBB, which is still considered solid, and the dividend appears to be safe. Right now, the stock seems to be fairly valued, with strong growth potential. And with dividend increases like this, Xylem could offer a very attractive yield on cost over the next 10 to 20 years, making it an appealing long-term dividend growth play. Xylem delivered solid performance in Q2. Revenue came in at $2.3 billion, up 6% year-over-year, with 6% organic growth as well. Adjusted EPS was $1.26, a 16% jump from Q2 last year. Pricing and supply chain strategies helped offset inflation and tariffs. Management credited their simplification efforts for improving customer experience and driving stronger margins. Let's talk segments. All four segments reported revenue growth, with strong demand in measurement and control solutions and water solutions and services. Measurement and control saw 12% orders growth, but margins dipped slightly due to inflation. Slide 6. Water solutions and services showed 24.4% adjusted EBITDA margin, the highest among all units. Applied water and water infrastructure also delivered steady 4 to 5% organic growth. Adjusted EBITDA margin hit a record 21.8%, up 100 basis points year-over-year, a clear sign of execution strength. Free cash flow, however, declined to $169 million, mainly due to outsourced projects and timing of tax payments. Here's the big one. They raised full-year guidance. Revenue now expected at $8.9 to $9.0 billion, up from the previous $8.6 to $8.7 billion. Adjusted EPS raised to $4.70 to $4.85. An adjusted EBITDA margin forecasted at 21.7 to 22.2%. So despite tariff and inflation pressures, they're confident. Still, let's talk headwinds. Tariff exposure could total up to $160 million annually, but Xylem is managing most of it with pricing adjustments. Also worth noting, free cash flow remains under pressure, and future gains depend heavily on successful integration of acquisitions. Positives, strengths, and tailwinds. Xylem delivered a strong second quarter, with both revenue and adjusted EPS showing solid year-over-year growth, a clear sign that demand remains resilient across core markets. The company also achieved a record adjusted EBITDA margin of 21.8%, thanks to a combination of pricing discipline, operational efficiency, and productivity gains. One of the most encouraging signals was the upward revision of full-year guidance, which indicates that management is confident in the momentum carrying into the second half of 2025. That kind of transparency and forward-looking clarity is something investors love to see. Moreover, Xylem's simplification strategy is starting to pay off, helping streamline operations and improve customer satisfaction. This is not just about short-term wins, it's laying the groundwork for scalable long-term growth. Negatives, risks and weaknesses. That said, the report wasn't without some red flags. One major concern is Xylem's exposure to tariffs, especially with ongoing geopolitical uncertainty. The estimated annual impact of up to $160 million could weigh on margins if not fully offset by pricing and supply chain maneuvers. Another issue is free cash flow, which declined year over year, primarily due to outsourced water projects and timing of tax payments. While management framed this as temporary, it's still something investors will want to track closely in future quarters. Lastly, although margins improved overall, some segments did experience slight compression, particularly in areas impacted by inflation and unfavorable product mix. That indicates some underlying cost pressure still exists beneath the headline results. So should you invest in XYL? If you believe in the long-term potential of clean water, infrastructure investment, and digital metering tech, Xylem is positioned well. However, I'd watch how they manage tariffs and cash flow in the next 2 quarters before going all in. Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.